Hi, welcome to this my third data update for 2025. For those of you at the time and the patience to watch the first two updates, I looked at US equities, and US equities in 2024 had a very good year. In fact, back-to-back years, 2023 and 2024. Now, when the market is up 20, 25, 26% as the US equity market was, you'd assume that everybody who's invested in US equities would have had a good year. Not necessarily, because a good year at the market level can hide differences across different groupings of the market. And in this session, I want to stay with US equities, but look at slicing and dicing those US equities into different groupings to see if there were differences in performance across the groupings. I'll start by looking at an obvious grouping, sectors and industries, to see which sectors and industries did well and which might have been lagging. I then want to follow by looking at companies classified by market cap. This is part of a long tradition in finance of what's called looking at the small cap premium, which is where the small cap stocks earn a higher return than large cap stocks. In this session, I want to look at what small cap stocks did relative to large cap stocks in 2024. But I also want to expand that discussion to look at it in historical perspective. What's happened to the small cap premium, especially in this century? And what should we be doing about it? I also want to look at what's called the value premium. Now, to call this the value premium might get some pushback from value investors because it's basically about looking at low price to book stocks versus high price to book stocks. Again, the conventional wisdom is low price to book stocks earn higher returns than high price to book stocks. And we look at the basis for that conventional wisdom. But I'm going to track it out by looking at 2024 and look at how low price to book stocks did this year, and again, casting in historical perspective. Now, along the way, momentum will be the untold story, so I'm going to close up by looking at how momentum did in 2024. Momentum effectively capturing how stocks that have done well continue to do going forward. So let's get the process started by looking at sector returns. Now, these are S&P 500 sectors, they're widely used. And in this table, I've looked at the returns in 2024, that's the last year, 2020 through 2024, that's the last 5 years, and also, as well as the last 10 years. Let's focus just on 2024 to begin with. The winner was technology, and most of you would have guessed that, but not by that much. Communication services was close behind, as was consumer discretionary and financials. What were the laggards? Materials, healthcare, real estate essentially came in, and you can see the returns on those sectors well below the entire market. So if your portfolio had a disproportionately large exposure to those sectors, I wouldn't be surprised if you ended up delivering a return less than what you'd have seen in the market. Now, sectors, of course, are very broad. They include a wide variety of industries. So I do break sectors down into 93 industries. In fact, I classify my data based on those 93 industries. And so I looked at the winning and losing industries in 2024. The worst performing industries were mostly old economy. You had steel, you had chemicals, you had rubber and tires. The surprise there, of course, is green and renewable energy. I mean, that's supposed to be the business of the future. Now, this part of this might be the energy business itself not doing that well in 2024. Green energy rides on the back of the overall energy business, but part of it is the disillusionment that many investors in green energy feel about its promise. For a while, green energy drew in money from impact investors and people who wanted to do the right thing. And there's some recognition that throwing money at green energy companies doesn't make climate change a lesser problem. So across sectors and industries, you can see the differences. The second slicing I did was looking at market cap. So here's what I did. I went to the start of 2024 and I classified companies into 10 deciles based on market cap. So the bottom decile are the smallest companies. This is across almost 6,000 US companies. So the bottom decile are the smallest companies, the top decile are the largest companies. And then I looked at the dollar change in each, in the aggregate. So this is millions of all of the companies in each decile and the percentage change. As you can see, it's very difficult to see a pattern here, but it does look like small companies did reasonably well. In fact, if you break the companies, the bottom half and top half, The bottom half delivered about a 24% return, the top half about 22%. You could even argue that if you want to call that a small cap premium, you could argue that there's some kind of a small cap premium, but it's very, very light. In fact, if you look at the collective value added by small cap stocks versus large cap stocks, you can see that it's really not a contest. So if there's a small cap premium, you need a magnifying glass to find it. And that doesn't surprise me because I've been tracking the small cap premium now for a long time. And for this, I have to express my gratitude to Ken French, who keeps an amazing database of research returns on capitalization, price to book, and every factor that they came up in the original Farmer French paper. And I used his data to look at what's happened to the small cap premium over time. So the way to read this graph is I've used different starting points to look at what the small cap premium would be if you looked at the difference between the lowest decile and the highest decile of stocks based on market cap. Let me repeat that again. The small cap premium I'm capturing there is the difference in returns between the lowest and the highest decile. And this graph looks at what that premium would be if you started at a point in time. So let me take an example. Let's suppose you go all the way back to 1927. That's the starting year for the data. And you go 27 through 2024. The small cap premium is 2.07% if you create portfolios that are value weighted. What does that mean? If you have 100 small cap stocks, the portfolio you create will reflect the market caps of each. So larger stocks among the small cap will get a greater weight. On a value weighted basis, there's been a small cap premium of about 2%. If you go all the way back to 1927. If you have an equally weighted portfolio, the return is 6.69%. What does that tell you? That the small cap premium, if it's coming from the smallest of the small cap stocks. And that shouldn't be a surprise. So that is the basis for the small cap premium. And it's become the basis for two things. One is in valuation. People use a small cap premium when they come up with the cost of equity for a small company. So in other words, they use a conventional risk and return model and add an extra 3, 4, in this case 2 or 6.69% to that expected return. In investing, it's become the basis for people tilting their portfolios towards small cap stocks. In other words, they have a disproportionately large amount of their portfolio invested in small cap stocks because of its history of earning higher returns. I think both those practices will need to get revisited. And to see why, take a look at the table at the bottom. So the way to read this table is I start my data at 1927, which is what most of the data services do. There is a small cap premium. Start in 1940, it's still there. By 1950, you can see the value-weighted small cap premium is starting to get really small, 0.81%. If you start in 1960 through 2024, it's still there, 1%. But starting in 1970, there has been no small cap premium on a value-weighted basis. And very shortly thereafter on an equally weighted basis. Think about that. There has been no small cap premium for the last 50 years. And we're still acting like there is one. I mean, we can attribute that to the inertia among appraisals, but I really think we need to re-examine this practice of assuming that small cap stocks earn higher returns than large cap stocks. Now, I wanted to drill down even deeper to see how much of the returns in 2024 how they were distributed across market cap classes. So I broke down my 6,000 US companies into percentiles, 100 percentiles. Take a look at how much of the market cap increase of the entire index comes from each percentile. The top 1 percentile, that's 60 stocks out of the 6,000, account for 74%. 74% of the increase in market cap for the entire index. The top 10% of all stocks, it's 600 stocks, account for 94%. It's a very top-heavy market. And you probably heard talk of this all through the year, how a few stocks are pulling the market ahead. And of course, the grouping that I think that most people think about when they think about concentration in the US market are those magical 7 stocks, the Mag 7, Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, and Tesla. To call these tech companies is, I think, a bit of an overreach because there's an automobile company in there, a chip company in there, a couple of advertising companies, a computer company, but they've been bundled together as the Mag 7. How much of the Mag 7 been responsible for returns? Take a look at this table. I've looked at the change in market cap at the Mag 7, and the numbers are truly mind-blowing. If you look at 2024, the Mag 7 collectively added these are all in millions of dollars, $5.57 trillion in value. That's a change in market cap. That was about 50% of the increase in 2024. In 2023, they accounted for 55% of the increase in market cap that year. In fact, if you look at the last 10 years, these 7 companies, just these 7 companies, have accounted for 15.8 trillion in increase in market cap and about 40% of the increase in the market. Now you can try to visualize what the US equity market would have looked like without these 7 companies, but you can already see that without those 7, all of the oxygen gets sucked out of the room. These 7 companies have carried the market. Now, this is not new by itself, the fact that a few big winners carry the market. In fact, there are studies that go back all the way to the 1930s that show that if you miss the big winners, now, Hendrik Bessembinder, for instance, did a study where he looked at what would happen to an equity market investor who missed the top few stocks, the top 20 or 30. And essentially, you end up with an investment an equity investment that earns less than the T-bond rate. So it's always been true that winners carry markets. What's different this time around is that the winners keep repeating. I mean, these 7 have been winning for such a long time that they've effectively become a big chunk of the market. Now, clearly, this is a market cap effect, and if you're looking at the small cap premium disappearing and the big winners getting bigger, you're saying, what's going on? There are 3 stories you can tell of with different consequences. The first is a momentum story. What's momentum? Momentum basically means money flows to the winners and away from the losers. So the winners get to be even bigger winners, the losers become even bigger losers. This is not new. Momentum is one of the strongest forces in markets, and a lot of trading strategies are built around momentum. Looking at relative strength, looking at how much a stock has gone up. And there is an argument to be made that what's happened in this century has made momentum stronger. In what sense? Momentum requires that you notice who's buying what and that you are able to follow them easily. And guess what? Both of those things have become easier to do as data access has become wider, social media has helped, and trading has become easier. So more you have this capacity to trade at low cost, and you can see what other people are doing, momentum is only going to get stronger. Of course, in the most extraordinary cases, meme stocks, you saw how social media can provide steroids to momentum. There's a second story, and this is a story that Michael Green, one of the people I admire the most in finance, has been saying for a while, which is his argument is the market's characteristics are changing as passive investing becomes more the rule than the exception. What's passive investing? In active investing, you try to pick stocks, you try to decide how much money to put into markets, you're trying to make active choices. In passive investing, you put your money in index funds or in ETFs, that's a more recent entrant, and you go back to living the rest of your life. In many ways, a more healthy way of living. But passive investing has been around since the 1970s. Jack Bogle came up with the Vanguard 500 Index Fund, greatest disruption in my view in finance. But since then, it's become much easier to invest in passive vehicles. You couple that with the fact that active investing is not very good. In fact, I'm trying to be generous. Active investing is downright bad. It delivers, on average, a return well below what you can make on index funds. And people can notice it much more easily now because you track your data in real time. Those 2 forces have caused a shift away from active investing, mutual funds that try to pick stocks, to index funds. The market share of index funds and ETFs exceeded 50% in 2024 for the first time in history. You're saying, so what? I mean, think of what an index fund does. It doesn't try to pick stocks. It puts money into stocks based on their market cap. So when money flows in index funds, it's going to flow into those stocks which have the largest market cap. It creates a fund flow that makes the largest market cap stocks get this consistent flow in, which keeps them going up. Of course, the whole thing could flip on its side, just like in momentum. And just as when momentum shifts against you, everything works against you. And if the fund flow starts to turn negative, you could argue the same thing would happen in reverse. For much of the last 10 years, the money's been flowing in. As it flows in, that money flows from the largest market cap stocks. And as a consequence, there is this upward push on, and maybe that's what explains why large cap stocks are doing much better than they used to relative to small cap stocks. But there's a third argument, which I think has nothing to do with what's happening in the market and everything to do with what's happening in the economy. The economics of many businesses are changing. What used to be splintered businesses are getting consolidated. You're saying why? I think technology is playing a big part in that transition. Let's take advertising. You go back 20 or 25 years, very splintered business. Dominated by whom? Newspapers, billboard companies, TV advertisers. It spread all over the place. Then what happened? First Google went public and then Facebook joined them. Today, if you look at advertising, the dominant players, it's consolidated, are Google and Facebook. You take car service. 20 years ago, the biggest car service in the company was probably a taxi cab company in Tokyo and New York, which owned 0.5% of the overall market share. Ride sharing changed that as well. Uber and Lyft, no matter what you think about them, and Didi and Ola and Grab have essentially created a consolidated business. In more and more businesses, we're going from splintering to consolidation. You're saying, so what? Well, it's going to play out in markets as well, right? You're going to basically see 2 or 3 big winners in every business. They're going to be the ones that rise to the top. Maybe what we're seeing in the market has nothing to do with the developments, or less to do with the developments like momentum and index funds, and more to do with changing business economics. That's not going to shift in the near term. So as long as these disruptions continue, maybe we're going to see the large cap effect. So whatever you think about, market cap and size effect, my only advice to you is don't blindly use a small cap premium. It's not there anymore. If you're investing, don't blindly sit there investing expecting the small cap premium to come back. I don't think it is. I think this is the long term, not in the sense that large caps are going to beat small caps. I think that too will transition out. But there is going to be no small cap premium in the 21st century, in my opinion. So we'll find that out. Maybe in 2100, somebody will look back at the century and see what's coming. But I would be very surprised to see a small cap premium in this century. Let's turn to the other big premium that investors and academics have talked about for almost, decades. It's called the value premium. And I put quotes around the value because value investors are going to push back when I call this the value premium. It's a very simplistic proxy for value. Low price to book ratios versus high price to book ratios. Now, starting in 1992, the conventional wisdom is low price to book stocks beat high price to book stocks, and it was based on the data. So let's see first what low price to book stocks did relative to high price to book stocks in 2024. Again, I've broken companies down based on deciles, their price to book ratios at the start of 2024, and looked at the dollar and percentage change. And again, the dollar changes are in millions in 2024. You look down, the percentage returns are all over the place, right? But it doesn't look like high price to book stocks are. In fact, the 2 highest price to book deciles earn the highest returns. Again, if you break the entire market, all 6,000 stocks, into a bottom half and a top half in terms of price to book ratios at the start of 2024, it looks like the higher price to book half outperformed the lower price to book half by about 4%. I know I'm not controlling for risk and all the neat stuff, but at least looking at it from the outside, if the conventional wisdom is low price to book stocks do better, they didn't in 2024. And again, looking in historical perspective, am I surprised? Not really. Again, what I've done here is what I did with the small cap premium. Look at what the value premium would have been given different starting points. So you start in 1927, it looks like there is a value premium of about 2 and again, this is with value weighted portfolios. It's equally weighted, the numbers look bigger. there's a 2.32% premium. You go back, you start in 1940, go through 2024, 3.3% premium. That is the basis for the legendary value premium. But just like with the small cap premiums, keep going through more recent periods. And you can see very quickly that in the last 20 years, there's been no value premium. Low price, the lowest decile of price to book stock. So again, let me be clear. I'm looking at the lowest price to book decile versus highest price to book. The last 20 years, the lowest price to book decile has underperformed the highest price to book decile by about 3%. As with the small cap premium, there seems to be no value premium anymore. And as with the small cap premium, there are investors holding on, said, this year is going to be different. We're going to go back. This is a temporary phase. But here again, you got to look at why it's happening. The first, I think, is a reason that many value investors might agree with me on. Price to book has become a worse and worse proxy for cheapness. Why? Because accountants have lost control of book value. I mean, the book value of manufacturing companies, accountants have a chance of getting it right. And those were the companies that were the center of the market in the last century. As we've shifted to technology companies and companies with intangible assets, accountants are grappling with how to bring them on. I know fair value accounting is trying and failing miserably, in my view. But the book value of many companies has absolutely no relationship to its true value. So using book value as a proxy is, I think, essentially is working less and less at these companies. So maybe the problem here is not that the value premium went away, but that price to book is no longer a proxy for value. Fair enough. The second is that momentum effect we talked about with small caps. Momentum is the enemy of the value premium. So even in the 20th century, when there was a value premium, in years where momentum was strong, the value premium went away. And all of the arguments are made about why momentum is stronger now, because it's easier to trade, easier to track the crowds. It will also become an argument for why the value premium is going to get weaker. And as with the small cap premium, there's a structural shift going on, which I think might explain the loss of the value premium. So at the heart of the value premium is the trust in mean reversion. What does that mean? You buy a low price to book stock. You know the strongest force that makes its returns higher, that it moves back towards the average. So much of active investing is built on mean reversion. And in the 20th century, it worked because the US was the most mean reverting market and economy of all time. We've extrapolated the lessons from that market and economy to a world that no longer seems to follow those rules. So maybe what you're seeing in the disappearing value premium is the loosening up of mean reversion. We talked about this in the context of the entire market, right? Where people have not been in stocks for the last decade because the PE looks too high relative to what? Relative to historic PE. I'm not saying mean reversion has gone away as a force, but it's become a much weakened force, and maybe that explains the absence of a value premium. So since momentum seems to be that guest nobody wants who stays on, let's take a closer look at what momentum did in 2024. So here's what I did. I broke down stocks at the start of 2024 based on how well or badly they did in 2023. That's momentum. The bottom decile are the worst performing stocks of 2023. The top decile are the best performing stocks. And I looked at the dollar change and the percentage change in 2024. It's a bit of a bounce back, right? The bottom decile was the best performing decile, but it's a really small decile. The top decile, though, was also the second best performing decile. So you can already see that barring the very lowest, the worst losers, there seems to be a very strong momentum effect. The top deciles do much better than the bottom deciles. In fact, if you divide all US stocks, 6,000 stocks, into bottom half and the top half in terms of momentum, it's no contest. The top half wins, hands down. Momentum continued to be a dominant force in 2024, continuing a theme that we've seen happen over much of the last decade. So what are the implications of what we see in 2024? I think there are implications for pretty much everybody involved in the process. For investors, I think that we need to re-examine how we approach active investing. To the extent that we're lazy and we fall back on mean reversion and looking at historical averages, which is what we're doing at the small cap premium, the value premium, hoping it comes back, I think we're barking up the wrong tree. I don't think we're going to get those returns. And a mutual fund manager who claims who claims 1 or 2% of your money as a management fee and then proceeds to screen stocks based on low PE ratios or small market cap or low price to book ratios, I mean, really doesn't deserve to earn that premium, because ChatGPT could do that for me. They're begging to be replaced. And maybe what we're seeing in the returns is an advance notice of, you better fix your act, do something that adds value as an active investor. Or you're not going to get extra returns. And of course, you can say, well, I don't think I can do anything to add value. Then buy index funds. For traders, let's face it, traders live and die on momentum. And as momentum is picked up, many of them have had a very, at least those who've been able to ride the momentum train, been able to earn high returns. The problem, of course, with momentum trades is you live by momentum, you die by momentum. There will be momentum shifts. It's not a question of whether, it's a question of when. And those traders who get caught in those momentum shifts might find 5-10 years of profits wiped out in one big momentum shift. So if you're a trader, you better practice the art of detecting momentum shifts before they happen. For companies, especially those that are trained to focus on stock prices as an indicator of how well or badly they're doing, well, everything I've said in today's session should be a reflection of the reality that stock prices have become noisier indicators of how well or badly you're doing. Put simply, there might be things that you do that are not good for the company, but add to the momentum and push up your stock price. Conversely, there are things that you can do that are good for the company, but cut against the momentum effect, and your stock price might go down. So I think companies need to be more careful about tying compensation to stock prices, and investors need to have more patience in judging companies and not just look at the price. As for regulators, there are going to be challenges that come about because of the market we're in. To the extent that this momentum force and winner-take-all phenomena play out, it is very likely that when there's a momentum shift, that there will be people who lose money. And those people would have been the people who were perhaps at the greedy end of the spectrum, pushing for it. And they will blame regulators and ask for protection. My advice to regulators is don't go there. Because in a sense, protecting investors from taking those acts, in a sense, encourages those investors to keep doing it. But there's another reason I wouldn't go there, which is, the line between, and it's not as if there are speculative, you can say, well, it's only those speculative instruments where I have to worry. The line between what is a traditional investment and a speculative investment has become grayer. Let's face it, GameStop was a fading retail company in 2020 when momentum took hold of it and became a meme stock. AMC and GameStop, both, you can argue, very quickly crossed that line from traditional, corporate, stock investments to speculative investments. You could argue that any investment on any given day can become a speculative investment in the market that we're in. And that's part of the cost of having markets, is you're going to have volatility, you're going to have sometimes stocks take off and stocks collapse. And as regulators, this is like plugging a little, the old story about building a wall against the ocean coming in. You're trying to plug holes. It's not going to work. So I think challenges are going to abound, and I think we need to more aggressively think about what we're doing well, what we're doing badly. We being investors, companies, regulators. And think about the best strategies for adapting to the world that's coming. I hope you found the session useful, and I thank you very much for listening.